My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour, the shadow trader himself, Peter Reznicek. I had Peter on, I think, back in December of last year. So a lot has obviously happened since then. Peter, for those who are not familiar with you, your work, talk about your background, your area of expertise, and how do you typically look at markets?
Yeah, absolutely. Thank you so much for having me, Mike. It's really great to be back with you again in this space. My name is Peter Reznicek, and I am a founder of ShadowTrader.net, and we're an advisory firm that mainly focuses on short-term directional trading, usually using weekly options. I run an advisory called the Weekly Options Advisory that deals strictly in short-term direction weekly options. We also sort of have a slightly different approach to things than most short-term options players do. We champion the idea of using options in a very creative manner by being what we call net short, which means not just selling options naked for credits or verticals, but rather structuring more complex spreads where you're just simply short more contracts than you're long. And thereby, through these structures, you can sort of win in all three ways, up, down, or sideways. So we have kind of a unique approach to it. I am also very steeped in market profile, which is, I believe, somewhat of an esoteric art that not enough people are paying attention to. It's essentially just the analysis of bringing time into the equation of price and volume, something that I learned directly from James Dalton, who's my mentor in that space. And to that effect, I also write a newsletter every morning called Peter's Pre-Market Perspective, where I analyze what's going on in the E-mini S&P futures overnight and the day before to try to get a handle on what types of scenarios may play out the next day to give readers a better idea of what type of price action might be coming at them, in the next day.
Okay, so let's talk about time frame for a moment, because some will argue that the long term is more forecastable than the short intermediate term. Others will say quite the opposite. I'm more under the school of thought, I think, like you, that the short and intermediate is more observable. Who the hell knows what happens long term? But I want you to talk about how you think traders and those in particular that play with options should think about time frame, not necessarily in terms of expiration of options, but in terms of formulating a thesis.
Do you mean like in general how they should think about how options sort of fit into their portfolio,
Yeah,
or how do
yeah,
you mean?
exactly right. And in the context of this sort of discussion around what is more forecastable, right? Kind of shorter or long term direction.
Right. So yeah, so that's very interesting because that really speaks very directly to what I personally feel uh, is sort of the holy grail of this whole thing, is that we all, if you understand options at all, you should understand exactly how time value works. And the way that time value works is that if an option is expiring from 3 months from now, let's say, right, it's not a linear basis, meaning that the amount of premium that's going to slowly erode out of that option does not happen linearly. It happens sort of linear for the first, say, 2.5 months, and then in the last 2 weeks it drops down precipitously, right? This is just sort of how the math naturally works of it. And this is why the arena that I play in and what I teach my followers is we're really focused on this kind of 1 to 2 week period. And within that, even as short as sometimes one day, sometimes even the day of expiry. And this is how I feel that people need to look at options, is that they may be missing the fact that there are huge opportunities to be had every day, every few days, once a week, or whatever, because of the nature of leveraging this time that is this deterioration of premium that's accelerating so quickly in these short times. And obviously, if you don't know what you're doing, this is a double-edged sword, because that brings into the equation what we call gamma risk, right? Is that if you are wrong, then that delta is accelerating very quickly against you. If you're short some options going to expiry or whatever. But if you do have a good handle on short-term direction, then I feel very strongly that this is a way that a lot of at least shorter-term traders should approach the market, because they have this extra sort of kicker out there of something that's working in their favor. Whereas people who only trade just strictly say day trading stocks or swing trading stocks or whatever. Something that's just very one-sided or two-sided in nature. That all there is either the up or the down. They're kind of missing this part. So that's what I try to tell people. Is this is something that I think people should be sort of adding to their repertoire.
Okay, and presumably volatility is a big part of that, right? Because when you think about volatility, people will argue that mean reversion is ultimately the best way to think about volatility, right? That if you have some kind of extreme down, you tend to see, because of volatility clustering, some kind of near intermediate setup for an extreme up, or vice versa. So talk about the role of volatility for a bit in terms of how you look at those very short time frames. Is it one of those things where you say to yourself, okay, if a certain extreme is hit, this is where I want to bet against it? Is there something that makes you do the opposite? Just talk about that integration for a bit here.
So the whole thesis of what I do is strictly directional, and it strictly starts from the starting point of technical analysis on the short term using hourly charts, daily charts, etc. So I'm trying to forecast what's going on over the next 1 day to 3 days, let's say, right? So it's very, very technical. But how volatility plays into that is the simple fact that when volatility is high, it affects all options across the board, be they puts or calls. It doesn't matter if you're trading, if it's Apple, if it's Amazon, if it's SPX, whatever. And what that does for us, at least, the people that I'm teaching and that are playing in my arena, is it affords you that many more opportunities because, as I stated in the beginning of the conversation, we are using relatively complex spreads that are multi-legged to achieve our objectives. And it's much harder to achieve those objectives when all of the premium is just clustered around at the money in low volatility environments like a VIX 16, whatever, when you're in the teens in the VIX, and there's no real premium outside of that, which makes perfect sense, obviously, right? I mean, the premium is a direct function of the volatility. So there's just that much more for us to do because we've got this sort of bigger playground to play in, a bigger sandbox, because we've got volatility up and down the chain. And this is, again, something that I teach people week in and week out, is that they need to use this to their advantage, because obviously on a mathematical basis, using Black-Scholes, every option is priced perfectly, really, right? Math wise, it's priced perfectly. But people who have some training in the markets and understand how things work and understand really where things could go and where support and resistance lie, et cetera, very, very well that even though the math is saying this is priced X, it's really going to be zero in 3 days. And more importantly, the odds of it being zero in 3 days are just so high that you have to take it. It just makes perfect sense. So that's a big part of kind of how we approach things.
And I will say, I'm sure there's some people in the audience that may be skeptical of this idea that you can know what's going to happen in the very short term, forecasting, as you noted, 1 to 3 days out. But I always make this point that history shows that when you're in low volatility regimes, usually when you're above a moving average, or utilities are weak, or lumber is strong, you tend to have these streaks in consecutive up days in risk assets where there's this autocorrelation, right? So if stocks are up on a Monday, they're likely to continue being up Tuesday, Wednesday, and even Thursday. It's in the higher volatility periods where that forecastability maybe goes down, right? Because that's when you have these kind of seesaw, up, down, up, down, up, down. And I think it becomes harder to identify, how to really play that, probably, unless you're trying to harvest some of that volatility with those options strategies.
Yeah, certainly the back and forth can be difficult, but I mean, for what it's worth, the track record speaks for itself, and we weathered that storm quite well. We actually, during the time period that things were really going kind of haywire, the advisory that I run, I think, went on a tear of literally, I think it was 21 winning trades in a row. And so we didn't have any problem with that. But I do agree with you. It's what part of the reason why those stats, for me at least, come out how they do is I really, really preach, caution more than anything. So uh, you just have to be very, very aware of when that volatility of what it's saying to you, because the problem that I think a lot of people fall into with options, because I've said this over and over, and it really drives me absolutely insane that the options community generally that is trying to sell you on advisories, or say, here's how you learn options or whatever, to people that have never traded options, is they want to sell you on the concept that options are easy because they have this component to them that is very similar to hand grenades as opposed to horseshoes, right? Because think about it, because I don't have to be exactly right, and I can sell this option out here or sell it down there, or iron condor this or blah blah blah, and I just have to be in this large range. And this is very, very disingenuous. And to speak to exactly what you were just asking me, is it becomes even more disingenuous and even more dangerous in a high volatility environment. When you're in a low volatility environment, yes, you can probably make that argument that, it's kind of more like a hand grenades game, and your horseshoe game doesn't have to be that strong. But when you're in a VIX 35, you really need to know what you're doing. You cannot just say, oh, look how rich these credits are, they're to be sold. It doesn't work that way. You're going to get run over.
Okay, so that lends itself to a discussion around identifying when volatility dynamics are likely to change. Now, you and I have known each other for a while. My world is around these idea that there are these indicators that tend to warn you in advance of higher volatility periods on average. You mentioned a VIX level. How do you yourself think about identifying if the volatility regime is likely to be higher or lower going forward, and then how do you adjust your options positioning based on that?
Well, firstly, you do have to understand, Michael, that I'm never looking out as far in time as you are. For instance, like I'm pretty well versed with your methodology and what you're trying to accomplish, and how you do it. So I think you have a longer time frame outlook. So it's probably slightly more important for you to know that. For me, I can just sort of feel it, really, as if you're used to creating spreads on options out of the money, and they're pricing favorably for you. What happens very quickly, that tells you right off the bat, even without looking at the VIX, you just start to see that when you do this stuff week in and week out, because we're always on the next Friday's expiry, we deal in stocks that all trade weekly. So that's as I was saying, that's what we do. So either SPX, or which is 5 times a week now, which is fantastic, or options such as Apple, Facebook, whatever. There's hundreds of them that expire weekly. When those spreads all of a sudden stop being able to be put on at night at good advantageous prices, when you realize that all of a sudden the brokering butterfly that you were putting on week in and week out for even money or a 5 cent credit is now costing you 35 cents to put on, the volatility, the volatility has obviously changed. Something has changed. It's not the same. So then you need to basically adjust your thesis a little bit. And the way you would do it is very simply, is that obviously if that volatility is smaller, everything is kind of compressing and crunching more to the mean, or at the money, if you will. And you just don't go out as far, right? You're looking at smaller targets. You're looking at putting the complex spreads where you think the market is, quote unquote, going there. That there just sort of comes in that much closer.
So I love that you use the term. You can kind of feel it, because I think this is kind of an interesting direction to go with for a bit here. So a lot of the sort of very well known, sort of legendary money managers will argue that they can usually feel something is off, but they can't quite identify what's causing them to feel that. It's almost like there's a subconscious aspect to the way they trade and look at the macro environment. And when you're dealing with options, you're dealing with complex math in a lot of ways, but you are also dealing with your own experience and your own emotional biases, right? Which naturally will affect everybody. Um, I want you to talk about periods where what you saw with your eyes, even though it made you feel like you should put maybe a particular type of strategy on, there was something internally that said to you maybe you shouldn't, right? I want to kind of get to this a little bit of discussion around the difficulty of what you see versus what you feel.
Yeah, that's really great, and I'm glad you asked that, because that's really a big part of what I do. So, and I'm not saying this is what everybody should do, but I will say this. One of the things that has made me very kind of good at what I do and very nimble and able to sidestep disaster over and over. Like I tell people this all the time when they're looking at, my track record in weekly options, or when I'm teaching them in webinars or whatever. I say this over and over. Your success has nothing to do with winning. Your success has everything to do with not losing. And these two things are completely different, because winning is easy. So you have to figure out how not to lose and not to let something bite you in the butt and not get into bad location situations where you're just dead wrong or whatever. So I'll tell you two things that work for me. One, as the moving and shifting of the equity markets is happening, and I'm looking at this, 1 to 3 to 5 to 7 day time frame as I'm placing my spreads, doing my weekly options. I am generally day trading futures at the same time, and this is not easy to do because that cognitive dissonance that you're speaking of definitely comes into play. But and I'm not saying I'm the greatest, whatever, but everybody has their own Achilles heels. But this sort of one has never been one for me. Like, I'm totally okay with being long a structure that needs Apple to go up and shorting the NQs, because I know that the NQs are going down for the next 15 minutes, but it's just that, I call it the Russian nesting doll theory, meaning that there are smaller time frames that live inside of larger time frames like dolls. And, if you can easily have a trade on that's playing towards getting to the biggest doll, but you can have another trade on that is counter that. And this is difficult for a lot of people to grasp and do, because, that cognitive dissonance of keeping two competing worldviews in your mind at the same time is generally hard for people. Like, why would I want to short this market if when I'm shorting it, it's hurting my Apple position that I need the NQs to go up to help? But if they would just think in multiple time frames at the same time, then they could do that, because the Apple position is doing what it's doing over the next 7 days. But in the next 15 minutes, I see that the NQs are trading 27 points above VWAP on the 5 minute. And I can see that the market internals are turning seriously negative here. And 9 times out of 10, it's going to get pulled to the VWAP. I'm going to short that, and it's going to drop to the VWAP, and that's going to be that. And during that time period, Apple's going to fall 60 cents. But again, that's just part of a much bigger cycle that's playing out. So, that's a part of it, really, I think, is when you have a relatively sharp or experienced and seasoned intraday game. And because I started in this business that way, long before I ever knew what an option was, I was a day trader of equities. So I think when you come from that background, one of the things that it does for you is it really helps you to get into the mindset of shifting gears and changing direction very quickly, very easily, without even thinking about it. So, that thing you said about how some money managers have this intuitive thing. Well, I see that because I'm in it. I'm in that short time frame as it's happening. So, I know that if a future is short, all of a sudden, it doesn't work and I get stopped out and it kind of rips against me. And then maybe I do it again or whatever. And I'm kind of looking at it and I'm saying, okay, this should be short, but I just got stopped out twice. This is not really working. So immediately I just apply that to the larger time frame. I say, okay, well then I probably don't need to be long these puts anymore either, right? Because this could easily, we're overly short. The market's down 3 days. Inventory position of all the players is heavily skewed in one direction. They need to cover, et cetera, et cetera. You just start, it's a fluidity is what it is. And that putting that very short time frame together with the slightly larger time frame for me works very well, because I just think, for me, they complement each other perfectly, and one sort of informs the other.
No, and I'm glad you emphasized that. I just shared it at the top of the space here. This tweet I put out in April of 2020, and I've made this point before, and it's hard to really get people on Twitter to understand it, because oftentimes people just react instead of think. But you can be both bullish and bearish at the same time. You can have strategies that are both bullish and bearish at the same time. It's all a function of your time frame with which it plays out, right?
Yeah, absolutely.
I think too often people get focused on a call or a direction, not keeping in mind the length of that call or direction in the way they evaluate anything.
Right, exactly. That's right. They're just not remembering that there are time frames to everything. And then even when what you're talking about, what we're discussing right here, if you think about it, is at the core of everything that trading really is. You have something that's going to go up for, let's say the run is like 10 days or it goes up for a whole month. It's really only the psychology of the players that decides whether or not they hold it 1 day, 2 days, 8 days, or they make the whole month out of it, right? It's their own time frame outlook, and it's their own psychology, right? And that's a whole other can of worms, but that's basically it. And as I always tell people all the time when we're discussing markets, like in, private live sessions with my subscribers, whatever, I just tell them over and over, like, remember that this is nothing more than an auction. And in this auction are really just groups of players that are segregating themselves into different time frames. And because of the different time frames that they segregate themselves into, the psychological ramifications are different for each one of those time frames. So you have these scalpers on the left. They're the first time frame. Their time frame outlook is 15 seconds, and there's nothing wrong with that. There's a lot of money to be made in good volatility. There's lots of money to be made in 15 seconds. So that's a certain time frame outlook, and with that time frame outlook comes a certain psychology about how to hold things, how to get rid of things, how to whatever. And then you kind of move up, as I said, the larger and larger dolls that fit into each one, that time frame outlook and that psychology changes, and the movement and shifting of the market is nothing more than the constant realignment of these time frame outlooks. Basically, that's all it is.
Okay, now you said success isn't about winning, it's more about not losing. And then you said the Achilles heel. And every strategy, every trader, anybody that's been in the business for longer than a hot minute will have an Achilles heel, an environment where no amount of experience seems to matter, no amount of logic seems to matter. It's just for whatever reason, everything's working against you. Right.
Yeah.
And I want to hit on that a little bit. And I'm going to hit on that a little bit from my own world. And I've always had advisors and investors say to me ask me the right question, which is under what conditions does what you do not work? And my response has always been an environment where it's purely about large cap momentum. So small caps don't co-move. You don't get any kind of momentum in things outside of mega cap stocks, which means you get whipsaw trying to play momentum that doesn't really persist there. And then the other environment, which has been really the case this year, is an environment where you don't have what's called classic risk off, where stocks get volatile and treasuries do what they historically have done on average, which is rally in price, drop in yield, flight to safety trade. Unlike this year, right, where stocks and treasuries have suffered the same kind of drawdown in an unrelenting sequence.
Right.
Talk about the Achilles heel that you find most options traders end up having, and I want to even address it for you, because you must be aware of environments where what you're doing may not be working for whatever number of reasons. But I want to talk about that Achilles heel point, because there's no such thing as a perfect strategy.
No, absolutely not. I think that my time frame outlook is short enough constantly, and I'm fluid enough to generally not get sucked into a certain worldview. To say what I mean to say is that what I do is very adaptable, and it kind of it works in all environments. Like, I don't think there's an actual environment that's not good for what I do, but certainly within the confines of what I do, there are going to be Achilles heels in terms of how I interact with it. So, like, one of the things that is I find very difficult, and I still to this day can't quite figure out what makes it do this, is that you will have sometimes stocks that will make large breaks, and there will be increase in volume, and I'm a huge believer in relative strength. And so you're looking at that equity, and on that daily basis, on that particular day, it's up, 5.3%, and the S&Ps are only up 75 basis and whatever. And there's just this huge relative strength. And I will then assume that this has to have some follow through, and I will enter accordingly. And there are definitely times where that relative strength, this has happened to us not that many times, but a handful of times over the years, it just literally falls apart the next day and there's nothing there. And I don't even know if that's predictable or if there's a way to do it. You kind of just have to go with that, because when all the signals are saying that, the tide has changed and this strength is here and it's the beginning of a move, there's really no way to to know that it could fall apart. So what happens, and now I'll bring this around to how a lot of options traders, how this becomes their Achilles heel. And you can kind of apply this to almost any trend. It doesn't have to be just like this one strong breakout day or whatever. They structure their positions in such a way that it is very debit rich. It's very high in debit. So they've laid out a lot of money. And that's okay, because in options, you get what you pay for. And the more expensive spreads will be worth more. If you want to grab a $75 wide vertical in Tesla, that's great. You're going to pay $17 for it. And, to turn 17 into 75 is great. That's wonderful. But you better be right, because that 17 is going to go to 16, 15, 14, et cetera, quite quickly. So to just kind of bring it around to what we do specifically, that's why I preach this whole, instead of focusing on winning, focusing on not losing. And we would look at that and structure the spread in such a way that it's not going to cost us anything or very little. So we may be able to structure, a risk reversal or some sort of broken wing butterfly or whatever, where we may be able to capture a big part of that $75 move. Maybe not all of it. Maybe we have a spread that captures $25 or $30, and maybe the stock does run 100 points. And you can look at it and say, well, it went 100 points, but you created this spread for very cheap for 80 cents, and then you sold the spread for $6, which to me is like a home run of all home runs. But other people may look at the chart and say, well, you could have just bought the stock, and every 100 shares would have made you 10,000, right, as it went up so far. And I don't look at it that way. That's why this is really what I pride myself on how we do things, and why it's a winning strategy over time, is that I'm not interested in that type of home run. I know that the markets are relatively so unpredictable and so difficult that I would rather have the peace of mind and knowing that going into it, no matter how good my TA is, no matter how good my setup looks, the nature of the markets is often to screw the most amount of people. It's just how it is on a short-term basis. So I don't care that I don't make the 100 points. What I want to do is structure a situation where if I'm dead wrong and it reverses the next day and completely falls apart, well, guess what? We're sitting in a spread that net cost us 40 cents. So it's just not a huge cash outlay, and that's the thing. And so what happens is, I think, with the Achilles heel, when people look at options, is they do one of two things. They either purchase single calls or puts that are somewhat out of the money, not super out of the money, I hope, like, buying cheap stuff. But let's say they buy, the $3 or $4 call, in Apple or whatever, that's a few dollars out of the money. And they think that this momentum is going to carry them there, but they're not realizing that so many things have to happen so perfectly for their $4 to go to 5, 6, 7, and it's just not worth it. It's absolutely not worth it. There's a better way to do this than to be risking that much premium and betting that direction, time, and volatility. Think about it, right? The three main components of options pricing. You are betting that all three of them have got to go into your favor. That is like a carnival game trick, like those games at the carnivals that are so rigged for you to lose. That's what you're doing, because it's nearly impossible to win on that. Whereas, there's just a better way. And that's basically what I teach is how can we structure in such a manner that we will make money if we're right, but if we are wrong, we will not lose money.
And I love that point you mentioned earlier about, so you have all the setups there, and it just, you enter the position or the trade, and it just doesn't want to work for whatever reason. And I always go back to this point: just because something in your process, some set of signals or single signal is not working or hasn't worked in the last few trades, doesn't mean you should ignore it going forward, right? Because,
of course,
right, you're always going to have these death by 1,000 cuts types of environments. I mean, I've gone through that many times with my. Again, nothing has kind of acted historically like risk off, so I'm getting smacked around because in the small sample we're in a very weird environment. But that doesn't mean that the signals, the opportunity set, which go back in time and are proven historically based on this research, doesn't mean it's an invalid. It just means there's this kind of funky environment where you kind of have to take it, kind of go through it.
Right, and you've got to stay the course, and that's difficult for a lot of short-term traders because, and we all make this mistake. Like, this will happen to me a lot, like intraday, where, I know the move is going to start and it's going to be bigger, but it's that death by 1,000 cuts. Maybe I'm just early, or, I attempt it once or twice, stop out here, stop out there. And then psychologically, it's hard because you're just not ready for when it's going to, the third time turns out to be the charm. But as we all know, we sort of we have this recency bias that messes with our head, and this is hard for all of us to battle. And because of that, we ascribe more value to the two things that just happened recently, and it blinds us to the fact that the big move is about to happen.
I'm going to bring up energy burrito, but I'll say one final thing on that point, and I think this is something people forget about these times when a particular signal or strategy seems to be off sync. And again, I'm living this. I've been living it really since February of last year when a lot of these divergences started taking place, but especially this year, right, with the way equities and treasuries have correlated. You need to have those periods where something isn't working, which other people may be aware of or may be following themselves, where you get that death by a thousand cuts that causes a degree of doubt that the anomaly or whatever it is that you're trying to take advantage of will actually be afraid to stay unarbitrageable. Right? I always go back to this point that if you have some strategy, some signal that's always working based on some kind of anomaly you've identified, the problem is that if you have that out in the marketplace and people are then tracking and following it, well, then now the anomaly that's designed to take advantage of gets arbitraged. So you
Yeah.
need to have these periods where people doubt, in my world, utilities being strong as a leading indicator of risk, lumber being weak as a leading indicator of risk, treasuries as a risk off asset. I know myself, even though I'm living through hell in the way that the myself run this year, even though I'm living through hell, I know that these periods are necessary because that's the only way the anomalies persist to create that doubt, to create fewer players trying to arbitrage the anomaly that I believe is still there. It's just
Yeah.
more of a side rant. I'm relating to myself. Everybody that's here again, make sure you follow Peter Reznicek. It's I'm not myself very big in the options arena, but I always enjoy listening to Peter from his knowledge, experience, and obviously having a different take on markets, which we're going to get into shortly.
Oh yeah, absolutely. It's been great. I always invite anybody who would like to get the spreadsheet of all of the trades in the advisory. They're certainly welcome to get it. It's something that we publish every single night. We update with all the trades of any trades or updates that have happened that day. And if anybody wants to get it, they can just email me at asktheshadow@shadowtrader.net. So we always send it, and it's been very solid. I think we've been doing the advisory for 3 years now, and we have almost been, I would say, at the high watermark of profits, like constantly. Like, it's like every week we're pretty much at a high watermark, which is really good. We had a little bit of a misstep very recently. Last week, we just had was one trade very anomalous, and I actually have a video. There's a link to a video inside of the performance that I invite everybody to watch, because we spent a whole morning session with the subscribers talking about it, because it was just very anomalous. It was a crazy monthly OPEX thing that just sort of ran me over in a spread. But overall, it's been fantastic. But to answer your first question is, somebody cuts you a check for $1 million, and then how do you do it? I would honestly approach it the same way that I've been approaching it, meaning that I would not take the money and put it down on certain equities and say roll the dice and say, okay, well, Apple's going to be higher 2 years from now or whatever, and whatever the million would buy or whatever. I look at it as buying power, basically, or margin. And I would just look at it as margin in doing what I do, knowing that I can pick my spots carefully, and on a daily and weekly basis, with time frame outlooks that are anywhere from 1 to 5 days, I can use that money as as margin to put on these spreads that expire every week, that I feel have huge propensity to work, both mathematically and when I put it together with technical analysis. And I would just keep doing that. But that's basically it. I mean, that's the way I look at the markets now. My own personal trading is nothing more than that. It's always everything I do in the advisory. I always do every single one of those trades myself with real money before I send it to the clients, meaning that every single trade in the advisory is always a cut and paste from my own fills. I use the Thinkorswim platform, and on that platform, you can just right click and say copy whenever you have a fill. And then I paste it into our chat room, and it goes to your mobile phone and whatever. And that's it. And then outside of that, like I said, I do a lot of intraday stuff, which is mostly in the futures market because of the liquidity that affords. And that in and of itself, if you want to do decent size, that eats up a lot of margin as well. So, I would just look at it as that. I've always felt that the markets are just more predictable, and there's just a lot of profits, et cetera, to be had in the short term. And that's why I've always just kind of structured my life around that. A lot of people always ask me my opinion on longer term stuff, and I always tell them the same thing. I say, one of the things that keeps me sharp in the short term game is the fact that I have so little bias. And the reason I have so little bias is because I don't really own any stocks long term. I don't. I literally don't. Outside of the markets, my longer term investments mostly revolve around venture capital and real estate. And think about it. What that does is when you don't have a separate long-term portfolio that's getting killed in a downturn, well, think of how much more objective it makes me, to make money off that downturn. I'm not hoping that it turns back up. I'm not sitting on, a retirement account full of Apple, et cetera. I'm not. I literally don't own any equities long term. That is a huge psychological shift compared to a person who is sitting on, a huge equity portfolio and they're watching it go to hell. And then how are they supposed to stay objective in the short term game when they're facing that? It's difficult.
And it's hard to stay objective also when when you have algorithms that are throwing at you on Twitter or other social media networks things that you probably already agree with. So this is another kind of part of a discussion here around how do you kind of stay true to a process and not override the process when you're inundated with information that sometimes you can't help but see because it's being thrown at you.
Yeah, absolutely. Of course. I mean, you can't. Of course, I'm not saying you can unsee any of that stuff. Of course, it is being thrown at you. But I'm just kind of speaking just this very specific thing of that. Because early in the conversation we talked about, maintaining different viewpoints in your head and doing two different things at once. And that's all I'm saying is that for me, because I keep my focus just in one or two time frames, and I don't have this longer time frame weighing on me, I'm able to be that much more objective.
All right, so let's talk about. So I want to go to the name of the space. So rally on or different this time, which kind of goes to what you were texting me about last week, which was a pretty sizable move in risk assets across the board. Although interestingly enough, Treasuries also rallied and bonds, had a pretty strong move as well. One of my things I've been arguing is that I think now you probably have an oversold bounce in everything, which would be bonds and stocks. Yields start dropping. Stocks see that as bullish, but then at some point they diverge, and that's kind of where your classic risk off really starts to kick in as the market maybe misreads the message of the bond market. I want you to talk about when you've seen big weeks like last week following a kind of a prolonged decline. That's where you haven't really had capitulation in a classic sense. How do you think about those kind of periods? Does a week like last week make you think, okay, well, maybe you're going to have a continuation of that move, or do you think it's more of a fake out?
For me, it's all about trends, and it's always been that way. I've always been teaching that the most valuable tool in the entire trading realm is very simply a trend line, and so if you're either going down or up, and you also have horizontal lines on charts where there are clear areas of support and resistance, which really we should think about as supply and demand. And just to really specify it to what's going on in the S&P, one of the things that surprised me on Friday, but at the same time as it surprised me, it has me thinking that yes, there could be a little bit more leg to this, is the fact that the S&P had a very classic double bottom area, which I call the Feb May low, right? We made that low in February, and then we made another low in very early May, which was on May 2nd. There was kind of a false break below that low, and then you had like two rally days after that in early May. And then when that low was retested around the 4130 area in the S&P, another down move started. And that down move is the one that took us to 3800. And so one of the things that I was talking about in my pre-market report on Friday morning was that I felt that this area in the ES around the 4095, 4100, I thought it would be more resistant. But it wasn't, right? Think about what happened Friday. Like you had a very early rally that held kind of a trending day, and you moved very aggressively to that 4100 area and you didn't stop. And by the time the market had closed, you were all the way at 4158. You were way above it. So the way you have to look at markets is I talk about this concept a lot called WWSHD, which simply means when what should happen doesn't. And when what should happen doesn't, means you should be thinking in the other direction, meaning like there's no reason to be sitting here hoping that it's still short, because if it was still short, I think that those prior lows, where there's this very clear area where lots of traders were quote unquote looking to get their money back, right? Because they're long from that area, and then it kind of fell apart from there, and maybe they bought that early May bounce. There was a lot, the market should have stopped there and it didn't. So then what should have happened didn't. There's probably more upside to be had. And where's that upside going to go to? That's pretty simple. There are multiple trend lines that can be drawn from the January high. So the main downtrend in the S&P will, like, let's say we went there tomorrow, because obviously trend lines move down along the x-axis every day, or up if they're going up. So let's say we went there tomorrow, that would be 4450. So if the S&P was at 4450 tomorrow, which obviously is 300 points higher than we are here, the downtrend would be over. That's not happening. So obviously, and then there's a secondary downtrend, which starts around in March, and it connects to a high of like the third week in April, like April 20th. And that is right around, if we went there tomorrow, that would be at 4,300, around 4,295. So let's say 4,300. That would change a shorter term trend, that would be there. So my personal take is what's going to happen here. The market should move to about 4,300. It'll be a little bit lower over time, because obviously next week is a shortened week. And let's say, I don't know, there's 4 days hence. So let's say we continue to go have some up action. We'd be at about 42.62, whatever, by the end of next week. That's another downtrend. That's also 50 period moving average on the daily. Should be some resistance there. So I hope everybody who's listening to this understands that, even I, whatever, or anybody, it doesn't matter. I don't know if what I'm saying is actually going to happen. I'm just thinking in terms of odds. And the way I approach the markets is just really to constantly just be eating in small chunks, always in small chunks. I'm not interested in getting long here and saying it's going to go to 4,300 and holding for that. I just know that the odds right now favor up more than they favor down in the short term, and I'm going to play accordingly. So I'll take constant small bites of it as it goes into that direction. And when it gets to that resistance, we have to reassess the situation. Now we just look to see, do we get a daily candle closing above it, negating that line, meaning that secondary downtrend is over and we might go to 4,400, or do we not? Do we reject? It's really that simple, and of course nothing is simple, but this is how I look at it. Just constantly looking at what is ahead of me. I'm here. What's 2 days hence? What's 3 days hence? Where is the next technical event that the market could go? That's basically it.
So here's something that I'm curious to hear your thoughts on. I've never myself looked into this, but I'm going to assume the answer is yes, but maybe not in a clear way. But is there seasonality when it comes to options trading? Right. So you're now in the sell and may go away period. Everyone uses that line, not understanding that doesn't mean stocks go down on average. It just means that your typical return during the worst 6 months is lower than the best 6 months, and volatility on average tends to be higher. But I want you to talk a little bit about the interaction of seasonality with options and option strategy. If you've seen anything that would suggest it's easier or maybe harder based on where you are on the calendar.
I can't really speak to that, Mike, because I just think that kind of, aligning yourself with those things, I think, is sometimes a fool's errand, because these things move and shift so much. And, there have definitely been times, I've been, looking at the market since about year 2000, maybe just right before, maybe 99. So it's well over 20 years. And there used to be long periods, I remember, where the summer, for instance, would be very quiet. And then I remember there were lots of periods where there was, the summer rally, where there would just be, huge price advances to be had, and thinking that it was going to be quiet and sort of, positioning yourself for a certain volatility, would have been wrong, because it came with another one. So to that, I would only say, that's not a type of thinking that I subscribe to, or that I would kind of let myself kind of fall into, because I think it could be a trap, really, to think in those terms. A lot of people always email me things about, they'll find snippets from the Stock Traders Almanac and, different things like that. And it says, well, historically it's, this month should be this, or this month should be that. I don't know about that. I kind of feel like, well, let's just let it play out. Let's let let the price action dictate it. We talk a lot about this concept called MGI, which stands for market generated information. And that's basically it. I try to base everything I do on market generated information. And historical facts like that are not market generated information. They're market generated information from a past time, but that's not the information that the market is generating right now as we're speaking. We're kind of dealing in the what is of this moment. And that I think is really important.
Yeah, no, and I'm with you on that. I think it's interesting to note, but to your point, it's like, well, can you really execute on any of that in reality? And even if you do execute on it, well, what if it's the false signal, and then you're really off, right, for
Yeah,
a very long
exactly.
period of time, right? So, I often am very against sort of these kind of one-liners that people often throw out. It's because it just is not really that helpful. I think people have to go a little bit deeper. All right, so
Totally.
right, so okay, so here's another thing that's been on my mind, and again, you're living this every single day. But um, post COVID, did the rise of retail and options trading by retail, did it throw any kind of classic or traditional relationships off when it comes to the options market? Were there more mispricings, more dislocations? Talk about how all of this kind of speculation may have or may not have impacted sort of the way options as a vehicle, as a way of betting on markets, works.
I think there definitely were dislocations, but they were very specific to certain sectors and certain names. Certainly, we cannot discount the rise of what people call meme stocks or message board trading and things like that. Certainly, the ascendancy of Wall Street bets and things like that. So Tesla, to be honest with you, is one name that comes to mind. Like I saw the options pricing in Tesla to me got very out of whack during times when Tesla was rallying hard and all of those internet people were kind of bulling it up and Robinhood accounts and whatever. So I think it's kind of to me it feels like it's more specific to certain names. I don't think it's a fully thing that is across the whole spectrum of the market. You don't really see that in SPX options. You don't see that in some of the bigger names. You certainly don't see that, I don't think, in big caps, but you definitely see it in highly speculative names. And again, speaking to what I was talking about earlier in terms of opportunity, when that volatility is driven higher, and you also have demand for lots of far out of the money options, this creates opportunities, like to create spreads that can be very cheap in price and have very low debit risk, but good payoff, et cetera. There's certainly it's certainly I think it's helpful. It's helpful certainly to somebody like me when you see something like that.
Yeah, no, that makes sense. Okay, I want to go back to what you said a little bit earlier. And again, everybody that's here, if you do want to ask any questions, don't hesitate to click on that bottom left button. Just make sure you follow me so I can coordinate a little bit on the back end for the remaining 10 minutes or so. And make sure you follow Peter and check out his work. You mentioned market profile. You do a market profile. You have this kind of unique way of looking at dynamics. Talk about what goes into that. What changes day to day, week to week, and what do you tend to look out for catalysts that might make you change that market profile view?
So the profile is something that is really it was something that was started in Chicago from floor traders in the futures pits a while ago, like in the early '80s, and we credit people like J. Peter Steidelmeyer and Kevin Coy was another gentleman. These are the kind of the beginnings of this when it was first started to be circulated as a theory. And then James Dalton, who taught it to me, he picked up the mantle with it very soon after. He was there right when it was happening. He actually bankrolled Steidelmeyer's first book. He sponsored the information because he brought it to him, and he was very impressed with it. And the guy needed some sponsorship to get his book going, so he did that. And so you have to understand that it's kind of a very nuanced sort of short-term way of reading futures markets that shows you certain nuances of price and time and volume that you're just not going to see on a more two-dimensional chart. So from a longer-term basis, though, as you're asking, there definitely are ramifications, and we see that over and over. So one of the things that we look at constantly when we're viewing the markets through the lens of the profile is we deal in where value is in relation to price. Price and value are two separate things. Price is something that is very of the moment. Mr. Dalton has always taught that price is an advertising mechanism, which is, I believe, 100% true, because price in the markets is not that much different from price in a circular ad from Best Buy. When you get that thing in your mailbox and it says there's a television set, and the television set has a big number next to it, and that number just seems lower to you than normal. I don't know, so that the TV is on sale, and you're like, wow, I could get this 85-inch TV for whatever it is. It says it's only $700 or whatever. So price in the futures market is really the same thing, because it wants you to engage with it. It's the same exact thing, like the people who send you the ad, they want you to engage. They want you to go to the store and buy something. The price is really constantly just advertising that to you. And when you understand this, you start to focus more on where value is. And value is nothing more than the price plus time, or the price plus volume, right? You need some time to elapse at certain prices to confirm that those prices are fair. Or you could look at it as volume is the same thing. Some volume needs to be committed to those prices at certain levels so that they are deemed fair. And this is what the profile does for us on the slightly longer term. It has immense value to day time frame futures trading, but it also has value in the longer term, because what happens is you start to see the movement and shifting of where value is over the course of a session in the futures. Usually we look at it on the ES, but it works on all futures, and it works on stocks as well. But let's just specifically talk about the S&Ps. You see very clearly where value starts shifting, whether value is higher or lower, or how large the value areas are, which is, roughly 70%. It's like one standard deviation from the mean. We look at where that, how big that value area is. That tells us a lot about the nature of the day, right? Because expansions of range with larger areas of value obviously are different from compressed ranges, right? With smaller areas of value. So I would say it's really in the concept of value that we bring the market profile analysis into the longer time frames in that sense.
I love that price is an advertising mechanism, because in my world, as somebody who's running funds and launches funds as an entrepreneur, nothing could be more true than that, right? Because that goes to the idea that assets follow performance, even though assets should follow after drawdowns, right? Which is when price is not really advertising, right? Even though it should be, because it's cheaper, which I think is always kind of remarkable. Okay, so for the final few minutes here, Pete, again, everybody, I encourage you to follow Peter here. How do you suggest people really actually learn how to look at complex option strategies, aside from obviously looking at your work? What are some of the books, or who are the kind of people that you think are worth paying attention to really educate? Because I do think that this idea that the best way to learn is to just start may not really be accurate when it comes to options, because they can be weapons of mass destruction if you don't really know how to use them.
Yeah, definitely. But here's the thing, Mike, is to that point, I would say that I just slightly disagree with that, in the sense that what I always tell people to do is this, and it won't cost them a dime. They really need to do this. Get your trading platform open. And with some brokers, you can even do this with an unfunded account. That is, if you have real time data, that's the thing. It doesn't matter what type of brokerage you're using, but you have to have real time data. But put the spreads on, and just put them on as working orders with limit order prices that will never fill. So whatever you're trying to buy, this broken wing butterfly, and you want to buy it for, you get what I'm saying. Like, you think it should be worth 25 cents or what, you put it at some low price or some high price. Some price is never going to fill, so that spread can sit up in the monitor tab of your platform. And what I always teach people to do is, as the way that you really learn options and really learn and understand when to put them on, when not to put them on, and what strategies to apply, is to watch the price of that spread that's sitting up in your platform moving and shifting with the market. And this is of paramount importance, because the mistake, again, that people make with options is they think, oh, this is easy. This is not like horseshoes. This is like hand grenades. I can just use time value to my advantage or whatever. But they really are not well versed, or many of them, unfortunately, don't even care in what the broad market is doing. And if I could really just encapsulate everything into a nutshell of everything we've been talking about, everything that I stand for, it's basically that if you don't know direction, you will be very hard pressed to make money in the market. That options are not this like magical vehicle where you don't need to know what the market is doing to make money. I think nothing could be further from the truth, and you're going to get hurt. And the best way to understand how options work, as I was saying, is put the spreads on in your account, leave them there without being filled, and have the real time data flowing through them and see, like, oh, interesting. Like, I put on this broken wing butterfly. I put it on for 10 cents, or, was trading very close to parity. It was almost free. And I see that it could make money if the market goes sideways or goes up a little. But notice that when the market goes up a lot, all of a sudden the spread is trading for, a 95-cent debit for me to close. Okay, so I would have put it on for zero. I would have lost $1. Why is that? Okay, why is that? Well, the spread is constructed of a very wide short vertical and a very narrow long vertical. So every moment that the stock is going up, the long vertical is gaining X, but the short vertical is losing 2X. Aha, okay. Huge light bulb should go off. Say, okay, so where would I apply this strategy then? Okay, so obviously this would work in this environment, but not in this environment. If I think the market's going to rip higher, maybe I shouldn't do this strategy. You see what I'm saying? And that's basically it. And if I urge people to put on 5, 10, 15, whatever of these spreads, put it in your account, make some notes, watch carefully, that this is really it. This is the work that you need to do. It's a big sort of trial and error, learn as you go. And this is how you develop the feel. And because you will have already seen, well, okay, I put this on in the paper account or whatever, or just in the monitor tab, and I see how it's moving, and okay, so now I see that could be dangerous when this happens. So which strategy would have worked in this environment, or et cetera, et cetera. That's really one of the best ways to do it.
Yeah, no, I think that's good advice for those that are here. So everybody here again, please make sure you follow, check out Peter's work. I'm going to have Michael Howell tomorrow talking about liquidity, and Kevin Muir as well in the evening. Peter, man, I'm glad we did this. It's been a while since we've chatted, so I'm glad we can reconnect publicly on Spaces. Thank everybody as usual for coming and to join this. I'm going to have this again as a edited YouTube video, and appreciate everybody. Enjoy the rest of your Saturday. Thank you, Peter.
Thank you so much, Michael. Much appreciated.
Thank you, everybody. Cheers.